Time for the latest earnings outlook now with Research Director Shiraz Mian. Q2 earnings season not far off. Give us a sense of what the early picture looks like. I'm hearing not so good. What are you seeing?
Yes, it is not so good, but let's not forget it hasn't really been that good over the last few quarters either. So yes, the expectations are weak. The pre-announcements are on the weak side. The early reports from FedEx, from Oracle, and some of the others have been kind of on the underwhelming side too, but it's too early. We have been typically starting out kind of on the weak side,
right,
and then ramp up from there. I have brought a chart for you to show you the evolving picture of expectations. As you could see, when the first quarter earnings season was getting underway, earnings in Q2 were expected to be up close to 4%. Kept coming down as companies guided towards this quarter, and right now it's barely almost in the negative territory. So they have been coming down, and they are weak.
All right, so let's talk about profit growth then. As far as the S&P 500 companies are concerned, Q2 going to be a flat growth period?
Pretty much. As this chart shows, 0.3% growth. I have a summary view of the quarter where I give the year-over-year change in earnings, revenue, and margins for Q2, and do the same for Q1. Total earnings are expected to be down 0.3%. From the same period last time. That reflects about 0.5% drop in revenue and essentially flat margins. Let's not forget, at the start of the Q1 earnings season, expectations were for negative growth as well. Turned out that growth was about a little higher than 2%, as the table shows. So yes, they are weak. Yes, they are close to flat, but we'll see how it turns out.
So growth close to flat, you're seeing flat margins as well?
Yes.
Okay.
Yes, margins have been flat-lined for a while now. As you can see in Q1, we had only 30 basis point year-over-year increase in margins. And that's about the same trend as is expected to unfold in Q2 as well. The big question on the earnings front is about what's going to happen in the coming quarters and in next year, and on that front, I have been a lot more skeptical than what the market has been buying into.
Yeah, still staying with Q2 though, flat quarter sometimes translates to flat stock market. Is that what you're seeing?
Well, the issue with the stock market is a little bit complicated because of all of these swirling things about the Fed and China and all these other macro questions. So if the market does zero in on a consensus view about the Fed, that yes, QE is coming to an end, for example, and going forward the market will have to navigate on its own, then earnings issues become very prominent. For a long time now, the market has been overlooking what's been happening on the earnings front. There hasn't been much earnings growth as we saw in Q1, as we are expected to see in Q2, and estimates have been steadily, in the aggregate, coming down. Typically, downward trending estimate revisions would be accompanied with a downtrending market as well. But the market was able to shrug that off with the help of this huge liquidity pump by the Fed. If the Fed is moving to the sidelines, then a flat earnings picture would be a problem for the market.
So if the market zeroes in on earnings in particular for Q2, without decent growth, there's no real fuel to fuel the next leg of the rally, right?
Absolutely. In fact, the even more problematic part than the growth picture in Q2 or the beat ratios, as we typically talk about, would be the guidance for the second half of the year, particularly Q3 and then Q4. And then the outlook for 2014, companies typically don't go beyond the following quarter. But let's keep in mind that expectations for the second half of the year and also for 2014 remain quite elevated. In fact, total growth, if we take the first half of 2013 and compare that to the first half of 2012, growth is less than 1.5%. But if you move to the second half of 2013, growth becomes close to 10%. So the market is looking for a very strong ramp up from Q3 onwards. If the focus will be on earnings, as I alluded to earlier, in a post-QE world, and the estimates will be going down, I don't see how the market can hold its own.
Okay, let's try to flip to something positive to end this conversation. Standout sectors on the positive side?
Finance. Finance is really standing out, almost 20% growth as my second table showed, and that's been a persistent trend in the sector. And the evolving backdrop appears to be even more favorable for finance. Pretty much all the key subgroups within finance, with the large banks, whether it's the regionals, whether it's the brokers and asset managements, the outlook for all of them remains quite strong, and we are seeing consistently positive estimate revisions for the group too. On the negative side, let's not forget about the negative.
But I wanted to end on a positive.
Well, the most negative is tech,
Oh,
which
okay.
is the big other driver in the S&P 500, and the sector will see double-digit negative earnings growth this quarter. In fact, I showed there's flat earnings growth for the S&P 500 as a whole in Q2. You strip out finance, and the negative becomes even more negative. So the outside of finance, there's not really much growth within the broader index as well.
All right, we'll be checking out with you throughout the season. And throughout the earnings season, Shiraz can be counted on to give us the play-by-play, as they say, as far as trends on the aggregate. And you can, outside of these video updates that we do with him, you can get those trend updates in his written earnings trends piece that appears on Zacks.com. If you're not there already, get on over once the season begins and check those out. And then on a day-to-day basis, because the trends are weekly pieces, the Ahead of Wall Street section, where he writes, is where he kind of fills in the blanks going day to day through earnings season. And we're going to be checking in with him every step of the way. With Shiraz, I'm Terry Ruffalo.